Hi friends, now in this session we'll discuss reading number 8 of equity, CFA level 1, equity valuation concepts and basic tools. Now this is the last reading of the subject. So here, whatever we learned in this subject till this point, we will apply all those concepts and we will see how to price or value the equity. With this, we also have the discussion on the preferred shares. So common equity and preferred shares. So main discussion is on the common shares, and then we will also see like how to do the valuation of preferred shares, right? Now, the first concept here is the intrinsic value and market value. Now, this intrinsic value is the fundamental value of the company. So this is based on some model or some method. Intrinsic value is based on some model or method. And market value is for any public company, the market value is the market value of the company, right? So based on, and this market value is generally based on the public sentiment, you can say demand and supply and so on. So let's say this is based on or investor opinion. The better word should be investors opinion, or let's say demand and supply. Okay, so based on this the market value is decided. We don't bother about this market value part. We are mainly focused in this chapter, we are mainly focused on the intrinsic value, which is the model or method based valuation. Now this intrinsic value is as per your calculation. So say for example, you do the calculation, I do the calculation, and we do these calculations from zero, from this starting. So we use our own assumptions, our own methodology. So it is totally possible that your valuation and my valuation will be different. Now here, if these valuations are different, then it is also possible that the intrinsic value can be greater than or less than the market value. Now, see what happens if the intrinsic value is less than or greater than the market value. So intrinsic value, if it is greater than the market value, so we say the stock is undervalued. Why? Because as per my calculation, the value should be 100 for a stock, and in the market it is currently trading at 90 only. So based on my calculation, it should be 100, but in market it is 90. So it is undervalued, right? So it is in the market's context. Always remember this: in the market context, it is undervalued. The reverse is also possible, right? So the intrinsic value is 90 and market value is 100. So here the market value is more than the intrinsic value. So as per my calculation, it should be 90, but market value is 100. So this is overvalued. Now, if you assume or if you think, this is maybe your opinion based on your analysis and so on, if you think like the values will approach, okay, so the market value will approach the intrinsic value. So if the security is undervalued, as per your calculation it should be 80, but you are seeing the value 90, then you should, or investor should, buy this security in this situation. And if this is the situation, that is intrinsic value is 90 only, the market value is 100, then investor should sell this security. Now here, in both the cases, the decision of buying and selling will depend on few factors. And here, if for example, if you own these stocks, in the overvalued case, if you own the stock, you will sell. If you don't own, then you will short sell. Now, the factors which affects the investor's decision of taking position, that is buying or selling the security, depends on the percentage. These are the factors which you should remember. So first, the percentage difference between the market value or market price, the better word is price, market price, and the intrinsic value as per your calculation. So if the difference between the percentage difference between the market value and the intrinsic value is high, then this will create additional motivation for the purchase. So it is investor will be more likely to take position if the difference is high. This is the percentage difference. Next is the confidence on valuation. If you as an investor, if you are more confident on the valuation, then automatically you will take the position. If you are less confident about the valuation and the percentage difference is also very less, then you won't take the position based on this calculation. Okay, so we are here comparing only the intrinsic value and the market value. Maybe there are other reasons because of which you may purchase this stock, but just simply based on the intrinsic valuation and the market valuation comparison, the confidence, the more confident you are about your valuation, more likely you are likely to take the position. The next is, if you are more confident about the accuracy of input used. So obviously in the model you have to use inputs. So we will discuss what are the models, and then you will understand. If you right now don't understand how the inputs are used, you will understand. Don't worry right now. So the accuracy of inputs used, like if it is more accurate, if you are confident that your inputs are accurate, then you are more likely to take the position. Then next, based on your experience or your opinion, you think the price will converge. Which price? The market price will approach to the intrinsic value. So if this is the situation, you think like this, then again, you are more likely to take the position. Okay. Okay. Now, these are the situations in which you will take the position in the stock, or any investor will take the position in stock. Okay, so you have to remember these conditions. So difference, confidence, that is the confidence on value, confidence on inputs used, and price, the conversions of price. How much it is likely, as per your opinion, if you think like it is the market value will approach the intrinsic value, then you will take the position. This simply means if the market value is 100 and the intrinsic value is 90, so market value will come down to 90. So this means the converging market value to intrinsic value. Okay. Now next. Now we have the models. Models of valuation. Okay. And here we have equity and also the preferred shares. So let's start with the equity first, and there is very short discussion on preferred. Now, first model is the discounted cash flow method, or simply discounted cash flow model. Then we have multiplier model, and then we have EV, enterprise value model. Okay, so here we will calculate the enterprise value. Here we will use the multiplier model as in the P ratios. Okay, so price to earning ratio. So this is the multiplier model, and discounted cash flow method is discounted cash flow. When once we start the discussion, you will understand. Now, in the discounted cash flow method, mainly our focus is on the dividend discount models. Okay, and then we will also see when the company is not paying dividend, then the situation is we can also go with the cash flows, right? Now, types of dividend. We are just building basics now. Okay, types of dividend. First is the cash dividend. So company declared say 20% dividend this year. So if say assume the face value of share is 100, and this is the face value, okay, and 500 is the market value of the share. So you will get 20% dividend on the face value. Always remember this, a dividend is paid on the face value, not on the market value. So on the face value, you will get the dividend, and the dividend is 20. So in exam, if you are provided with these two information, so market value is 500 and the face value is 100 and the dividend percentage is this much. So then you have to use the dividend in your calculation, say. So in this case, always remember, you have to use the dividend percentage on face value and not on the market value. So this is a cash dividend. In cash dividend, dividend is actually paid in cash to the investors or the shareholders. Next is the stock dividend. Now, stock dividend is paid in the form of stocks. In the form of stocks, as in, say you hold 10 stocks. So for every investor holding 10 stocks, you will get 1 share extra. Okay. So this is in the form of stocks. So for example, 1 for 10. So if you hold 10 shares, then you will get 1 share. If you hold 100 shares, you will get 10 shares in the form of stock dividend. So this is the stock dividend payment. So here the dividend is made in the form of stocks. Now just remember this. In both the situations, okay, both as, and I'll also add the other parts also, but for now, we have the discussion on the stock split, reverse stock split, and the share repurchase also. But in all situations, the net worth of shareholder is exactly same. Okay, so there is no impact on the net worth of the shareholder. I'll give a simple example with the cash dividend, and same is applicable for all the other topics. Now let's say this is the company, and in this company the net asset is of say 1000. Okay, just say company. And for now, let's assume you are 100% shareholder of this company. This will simplify our discussion. If you understand with 100% assumption, automatically, then you can also understand with the 1%, 2%, whatever is the proportion of holding you have in this company. Now, but for now, let's assume that you hold 100% shares of this company. And let's say you have 200 shares. Okay. Now, each share is worth $1. So currently, your total worth is, net worth is, just a second. Each share is worth 5. So your total net worth is 1000. Okay, so simple. So this is your company. So you are holding 200 shares in this company. So you have 5 per share price. So 200 multiplied by 5. So net worth is 1000. So even if I don't provide you this information, if you simply check this company's value, where the company's net worth, the net asset of the company is 1000, and you own this company, so automatically your net worth is 1000. Now what happened? Because you are the owner, so you said, okay, just do one thing. You ask company. So company is paying dividend of 200 in cash. 200 in cash. So this means once the company pays 200 in cash, so from company system 200 cash is out. Now whatever is left is the net worth. Okay, let's call this as new net worth, and the new net worth is 800. Simple. Okay, new net worth is 800. Now what happens? You have 200 shares, and remember, so this shares value is directly linked with the total net worth of the company. So this is the assumption we are using right now. So your total value of share should be 800. So share price in this situation will be 4 per share, and your net worth will be 800 plus. What is this plus? Remember, company paid 200 in cash. So now you have 200 cash. So 200 cash paid by the company, and your share value declined because of this dividend payment. When the dividend is paid, cash is going out of the company. So company's net worth will decline. If the company's net worth declines, share price will come down always. Okay, so it will come down. So this is the situation. See this. Previously it was 5 per share. Now you have 4 per share. But it is not affecting your net worth. It is not affecting your net worth. So here this calculation is very simple. So if you see this, again, your net worth is 1000 only. So 800 in the form of shares and 200 cash received. So your net worth is 1000. Now remember, it doesn't matter how much cash dividend is paid by the company. Okay, it can be small, big, any amount. the net worth is going to be the more or less same, assuming like all the other factors are like constant. So the investor's net worth is not affected by the share dividend payment, or sorry, the stock cash dividend payment. Okay, and same is applicable for the stock dividend payment also. Okay, so even in the stock dividends case, the net worth is going to be the same. Got it? Now, but if company pays the dividend, then company's net worth will decline. Okay, so company's value will decline after payment of dividend, but the investor's value stays the same. So this is the point you have to remember. Got it. Next point is the stock split. Stock split is very simple concept. So when the company thinks like, okay, so currently the share value is really high. Okay, so let's say the share value is 10,000, and company thinks like, okay, so if the share value is this big, then they won't be able to attract the retail investors. So companies want to attract the retail investors. So in this situation, obviously, if the share price is 10,000, then general retail investors won't buy it, because one share will cost $10,000, and even there is a psychological effect, right? So you are not going to buy, like it gives intuition that the company shares are very overvalued, like highly overvalued. For this, what company does? Company splits share. Okay, so now if say shares value is 10,000, one share's value is 10,000, so company will split this one share into say 5 shares. Company will split this into 5 shares, and if the company splits these shares into 5 shares, so one share is split into 5 shares. So think of it like, say, like one share is just the envelope where you have $10,000. Okay, and then you split it into 5 envelopes. You keep all the 5 envelopes, no problem with that, but now it is in the 5 envelopes. So your net worth is still the same, but envelope size, the value of every envelope is now lower. So it will be 2,000 per share. Okay, so the investor's value won't be affected. Now if you consider the company, let's say this 10,000 is the total value of the company, and previously there was only one share issued by the company. I'm taking very like hypothetical example because I have to give you the understanding. Okay, don't, if I use like say 10,000 shares and 1 lakh, 1 million value of the company, then your brain is engaged in all those calculation part. Okay, so instead of calculation, I want you to focus on the concept part. Just focus on the concept. Company had previously issued shares. So one share issued, value is 10,000. The net worth of the company is 10,000. And again, we will assume the book value is the share value of the company. Okay. Now, company decides to stock split. Okay. So here, you will get the 4 for 1. So here, in this case, you will get 4 stocks for 1 stock. Now, in this case, this one share will get converted into 5 shares, and each share will have value of 2,000. But remember, it is not going to affect the net worth of the company because it is 2,000 multiplied by 5. So ultimately the net worth is the same. It is just, you can think of it as like, this is a book entry. Okay, so in the books, company is just changing the value, number of shares issued, right? So this is a stock split, simply splitting one stock into multiple stocks. Then there is also reverse stock split. And in the reverse stock split, what happens? It is just a reverse. Okay, so converting 5 shares into 1 share. So this is the reverse of stock split. So say 2,000 shares and 5 per share. So total value of these shares is 10,000. Now company does the reverse stock split. Reverse stock split where company is converting 5 shares into 1 share. It is kind of merging multiple shares into 1. So 5 into 1. So now you will have share 10,000 worth Okay, automatically its value will increase and net worth is same. So investors' net worth is not affected even in this case. Then we have a repurchase. Repurchase of shares. Now when the company thinks the shares are undervalued, so what company will do? Company will buy back the shares. Okay, so this is the repurchase of shares. Repurchase or buyback. This is also known as a buyback of shares. So in this case, the calculation is very simple. So let's say you hold 1000 shares at 20 each, okay, $20 each, and total value is 20,000. Okay, and company repurchases shares from you. Company repurchases shares, and let's say 100 shares repurchased. So 100 shares repurchased by the company. So now you will have 900 shares. Share value won't change in this case. Remember, it is 18,000. So share, but remember, company purchased 100 shares from you, and let's assume for now company purchased it at 20 only. Okay, so obviously it is generally the market price or slightly more than market price. It is never below market price. Okay, now company purchased shares, repurchased shares. So 900 shares multiplied by 20, 18,000. So you have share value 18,000, and remember company paid 20 for these shares, so you will have cash of 2000. So again your net worth is 20,000 only. So net worth is not changing. So net worth is going to be the same in all these cases. Okay, I hope you understood the concept. Okay, so these are the concepts you have to understand, the basic discussion. Now next is the dividend declaration, like the system, how the dividend is declared. This is the timeline. Now first is a dividend declaration date. So this is the date on which the dividend is declared in, say, AGM or like this. Okay, so the board will declare the dividend. Shareholders don't declare dividend. Board declares the dividend. Then this is the date at the same time. At the time of declaring dividend, X dividend date is provided. Now this is the X dividend date. Then we have, I will explain each and everything, don't worry. Holder of record date, and then we have dividend payment date. Let's say this date is May 15th, this is June 15th, then June 17th, and then June 25th. Okay, now see what happens. Now when company declares dividend, company will provide, okay, so this is the dividend we are going to pay. Let's say the dividend value. So currently the price of the share is 100 and dividend declared by the company in dollar terms. So I'm converting the dividend declared by the company in dollar terms. So let's say in dollar terms, per share dividend will be $5. Okay, so 100, company will declare dividend in percentage terms, but we are converting it into dollar. Now the price is 500 and the dividend declared is 5. Now on this date, this is the X dividend date. This means if you hold share on this date or after this date, you hold dividend on this day or after this day, you're not eligible for dividend. You're not eligible for dividend. So this means you must hold this share in between this period. Okay, so before this date, okay, before X dividend date. So if you hold share before X dividend date, then you will get the dividend. Now on this X dividend date, what happens? Let's take one example. Okay, it's just one day before X dividend date. And then we will see just after, like on the X dividend date. So if you purchase share just one day before X dividend date, so you will buy this share at, let's say, 100. But remember, in this 100, you will receive dividend of 5. So the actual value of the share is 95 only. Because remember, you are just buying it just one day before the X dividend date. Okay, so on this day, still you will be eligible for the dividend. The value is 95 and 5 is the value of dividend in the form of cash. Now immediately after this, okay, so you purchased share on just one day before, and then on the next day you sell this share to someone. This is on the X dividend date. You sell this share, but see what happens. Because now we have X dividend date, so the investor is not, the holder of the share on X dividend or after X dividend is not going to get any dividend. He will say, okay, see, I'm not going to get the dividend, so I will pay you only 95. Okay, so you purchase the share at 100 and you sold this share just one day after at 95. So someone will say, okay, there is a loss of $5. But remember, this is the X dividend date, and just before you are holding share just one day before this date. So you are eligible to receive the dividend. So you will receive the dividend. And because you receive the dividend, so this is your dividend. Okay. So dividend will compensate for this loss. So here, this loss is compensated. So ultimately, this is the purchase price, this is sale price. You sold it at 95. So 95 plus this dividend, 5. You sold share at 95 and you got the cash dividend of 5. So your value is total, your value as in like the cash value you hold is still the 100. So you are not losing anything. And when this investor who is purchasing share on X dividend date or after this point, so he is purchasing at 95. Very logical. Okay. So this equation works like this only. Okay. So if you are holding the share on the before X dividend date, so for you, the total gain is like 100. So you are not losing anything. So you purchased it at 100, you are selling it at 100. Share price is dropping and the share price dropped to 95. So the next person on the X dividend date or after that, he is going to purchase it at 95. Now, if you see the situation, so price is dipping from 100 to 95. So there is a decline in price. Why there is a decline in price? Remember, company paid cash of $5 out of the company, right? So the cash of 5 is coming out of the company and 5 per share. So automatically, for that share, the share is simply you have the residual interest in the company, and because company paid the cash, total net worth of the company is lower. So for this investor, the company's net worth is lower. So he's like the value remaining in the company after making the cash payment is 95. If you have, again, I'll give you a very layman's example. You have bank account, okay, and in that bank account you have 10,000 rupees or dollar, whatever is your preference. And say you decide to, like, I'm asking you to sell me that bank account. Okay, so obviously you will say like pay me 10,000 and take my bank account. Okay, I'll take your bank account. But what happened, like in between this transaction, you had to make the transaction. So you paid 2,000. You paid 2,000 from that bank account. Now the value remaining in that bank account is you paid cash from that bank account. So value remaining in that bank account is 8,000 only. So obviously now the price of that bank account will be 8,000. Very simple, right? So same thing happens in case of the company. So you have share, if the company makes the cash payment, so cash is going out of the company, and because cash is going out of the company, the share price will decline. So this is the share price decline. So nothing is wrong here, right? Then we have the holder of the record date. Holder of record date. So what is this holder of record date? Now, when this transaction happens on the ex-dividend date, before ex-dividend date, and so on, company needs time to record all these transactions in their register. Company maintains a register of shareholder where they will properly record like who is currently holding these shares, who is currently selling and buying, and all these transactions. So those who are holding shares on a specific date is recorded with the company. The company holds all the records of the that particular shareholder. So holder of the record date means on this date, company will have all the updated information on who was holding share just one day before this ex-dividend date. If you are holding shares just one day before ex-dividend, but you sell it on ex-dividend, so your name will be recorded in this, okay? And holder of the record date at this date, on this specific date. So your name will be here. With name, there will be address, okay? And other mail details on like that. So now company have all the information on who are the people or who are the investors who were holding our shares on this particular date. So maybe there are other shareholders who are long-term investors who are holding these shares, and also you are the investor who purchased the share just for one day. So your name and the other people's name will get recorded here, okay, in the register of shareholders. Company will use this register of shareholder, and then they will mail their checks. Nowadays, like it is online also, right? So company, let's assume the check transaction. So company will check the dividend checks to these register, like the shareholders who are in their register like this, okay? So very simple. So these are the dates. So just to summarize, dividend declaration date, on this date board declares the dividend. Ex-dividend date, on this date or after this date. Dividend, if you hold shares, you won't be eligible for the dividend which was declared on this date, okay? Maybe if the company declares dividend afterwards, then you will be eligible, but not before, like the previous one. Now ex-dividend date is here. So company needs time to update their record. That's why we have holder of the record date. On this holder of the record date, company will have all the information on who are the investors or who are the shareholders holding shares on just one day before the ex-dividend date and the dividend payment date. On this dividend payment date, company will check their register of shareholders and they will take the address and they will mail you the checks of dividend. Simple. And that's why you will see the 15th May is dividend declaration date. There is a good gap between the dividend declaration date and the ex-dividend date. So on June 15th is the ex-dividend date. Company takes time, which is approximately 2 days. T+2 transaction is there. So approximately 2 days to update the record. That's why generally it is just 2 days. 2 days after the holder of the record date is just 2 days after the ex-dividend date. And then in few days, company has to pay the dividend, okay? So there are clear guidelines on like in how many days company must pay the dividend and everything, okay? So it depends on country to country, okay? So it's totally regulated thing. Company can't be like, okay, just let's declare the dividend and we won't pay the dividend. Not possible. If company declares the dividend, they have deadline. Before that time, they must pay the dividend. Now from this point, we have very interesting discussion. The first part is on the dividend discount model. Dividend discount model. And here I'm assuming like you are aware of all the fixed income concepts, the bonds concepts and everything. So ideally you should prepare this chapter after you are done with like most of the curriculum. Okay. Now here we have the concept on dividend discount model. Now dividend discount model is pretty simple and straightforward. Okay. There is nothing special in this model. If I provide you information, very certain type of information that company will pay dividend at the end of 1 year. I'll provide this on timeline. Okay. So company will pay dividend at the end of 1 year, and the dividend is equal to $10. And you are certain, and we are certain, that you will be able to sell share at 100. Now two things are there. First, you will get the dividend of $10 at the end of 1 year, and at the same time, on this day at the end of 1 year, the share price will be 100. So you'll be able to sell this share at 100. You sell it, don't sell it, like it's your choice, but we know for sure that the share price will be at 100. Okay, and based on our estimate and so on. Now the question is, what should be the price of share at point t0? This is the point t1. So you have to calculate the price of share at point t0. So you have to calculate p0, today's share price. Today's share price. So very simple. Okay. What we will do? Discount this cash flow, and simply total it, and you will get the answer. Now the question is, like, what should be the discount rate? Now the discount rate is, here, let's say this discount rate is K, then I will develop on this. Okay, so K, and the rate is 8%. Rate is 8%. So dividend is 10. So we will discount it. So 0.08 to the power 1, because this is a 1 year discounting. And we will also discount the cash flow, 1 plus 0.08 to the power 1 only, because this is again for the 1 year. So if you simply solve this, so answer is, so 10 is 110 divided by 1.08, 101.85 is the share price today. That's it. So this is a dividend discount model. So you are discounting dividend. So that's why this is a dividend discount model. Now this you already understand, like this is the dividend. This is the dividend. Okay. And this is known as a terminal value. Terminal value as in the value of share at a specific point. Fine. And what we did here is the 1 period dividend discount model. I'll simply write it as DDM. Okay, this is the 1 period dividend discount model, because we are doing the calculation for 1 period only. Now I'll simply change like this calculation, the payment structure. Let's say you will receive dividend at the end of 1 year, which is say equal to 10. Then you will receive second dividend at the end of second year. Let's say it is 15. And the price, expected price is 150. Okay. So P2, the price at the end of year 2 is expected to be 150. You will get a dividend of 15. And then at D1, you will get a dividend of 10. Now again, calculation. P0 is equal to K is 8%. So we'll start with this. So first we will discount D1 by 1 year and D2 and P2 by 2 years. So let's see. So 10 divided by 1.08 to the power 1. And I'm assuming you understand all these concepts of discounting and everything. And then 110, 115. 115 divided by 1.08 to the power 2. Okay, so 15 plus, this is not 100. 150 plus 15, 160, 165. 165. So simply discount it and you will get the answer. This is 9.259 plus, I'll just show you on calculator. Now this is 10 divided by 1.08, whatever is the answer, store it in the 165, wait a second, 1.08 square 1 by x multiplied by 165, whatever is the answer, store it in the 2, recall 1 plus recall 2 is equal to 150.720. 150.720. So this is the price, and because we are using more than one period, this is known as the multi-period dividend discount model. Okay, very simple. Simply we are discounting the dividend, nothing else. We are doing, like, this is not at all special thing, right? So this is same as bond. Now this dividend discount model is useful only for those companies who are paying dividend, right? Paying dividend. They should be paying dividend. Now the question is, when company pays the dividend. Now company pays the dividend. That is simple rule. So company pays dividend when company's management thinks that we won't be able to, as a management, we won't be able to uh, give better returns to the investor compared to what they can do by themselves. This means, say this is the company and this is the investor. If the investor invests by themselves, they will be able to yield a 12% return on the cash. If they have the cash, they will invest and they will get a 12% return in the market. Now the problem is, this company is mature company. So company don't have any expansion plans. Company is not like, they don't need cash and everything. And also, if like they have some venues for the investment, but those venues, they know, as a management knows that the venues will be able to yield only 8% return. Now, in this situation, when company's management knows that if they invest, they will be able to yield 8%, but if the investor invests, they will be able to yield 12%. So in this case, it is always better to disburse the cash or return the cash to the investor. It is always better. So what company will do? Company will simply, let's say this is the dividend. So company will pay dividend to this shareholder. This dividend is in the cash, right? So if the company is not paying dividend, then company is holding this cash of $10. And remember, companies won't be just holding these cash just like that. Okay, and there are limitations for the company. If the company is have the the objective of the company is to do some specific type of business, company can mainly do that business only. Okay, it is not like one company can directly enter into some another business. Now here the company don't have venue, so if they invest, they will yield 8%. They know the investor, if the investor invest, they will yield 12%. So it is better pay them this cash. So company will get rid of the idle cash they are having, and even the investor will be happy. Like, see, the company is so nice, the management is so nice, they are paying us our cash, and we will invest this cash and we will yield better returns on the same cash. Okay, so this is how it works. But this is applicable for the mature companies. Mature company is like where the growth is done. They don't have any capital investment plan. They don't have any expansion plan and so on. Okay. In this situation, company should pay maximum dividend. But if the company is growing company, okay, very new company, growing company, where company have lot of investment plans, lot of plans where company thinks like they have better opportunities. Company thinks like they can provide 15% return to the investor, and if investor invests by themselves, they will be able to yield only 12% return. So in this situation, this company is not going to pay dividend. If the company is not paying dividend, then we have new problem as in, because our dividend discount model, in the name itself there is a dividend. So if the company is not paying dividend, then how to value this company? So in this situation, we have second alternative. The alternative is cash flow based valuation. Cash flow based valuation. Everything is same. Okay, everything is same as this, except instead of dividend, we will use cash. And this cash is free cash flow for equity. This is FCFE, free cash flow for equity. Now, here I'll assume you are done with the cash flow chapter from FSA. So free cash flow for equity is calculated using the simple formula. If you go by the net income route, then in the net income, first you have to add back the non-cash expense, that is depreciation. Add back the depreciation minus changes in working capital. Okay. Then minus capex. If there are any capital expenditures, then capex should be removed, because if the company is investing in capital, then this is the cash outflow, which won't reflect in the net income. That's why we have to separately remove the capex and then separately adjust for the dividend debt adjustment. So here debt interest is reduced. Sorry, debt principal payment is reduced. And if there is a new debt, then it is added. New debt is added. So if there are on the principal part, you have to remove it. If there is any principal payment, because principal payment is not captured in the net income. In the net income, we will have the interest impact, but there is also the principal repayment. That principal repayment is not captured in the net income. And if the company is procuring the new debt, then new debt should be added. Now here, this formula is very, very, very easy if you understand the cash flow statement chapter. If you don't understand the cash flow statement chapter properly, then it is super difficult to understand this formula. So in my opinion, like my suggestion is simply remember the formula. Okay, the best situation is like remember the formula. Now here this net income is easily understandable. Depreciation part is easily understandable. The depreciation, actual depreciation expense is a depreciation expense. Okay, easily understandable. Now we have the working capital, changes in working capital. Now understand very important point. This is changes in working capital. Working capital is current asset minus current liability. So say working capital's opening balance, the previous year's closing balance or current year's opening balance is say 100. And it increases to 120. Okay. So the working capital increase means investment in cash. Okay. Investment in working capital. So this should be removed. So if the working capital is increasing, so this change 20 will be removed because this is increasing. So increase in working capital, whatever is the amount, increase in working capital should be removed. Remember this is the point where students make mistake. Increase in working capital should be removed or subtracted. And decrease in working capital, let's say, decrease in working capital. This is the situation 1. Okay, now the situation 2. Decrease in working capital will be added plus 30. Okay, so simple. If I am talking about this term combined. Okay, so minus change in working capital. So increase in working capital, you will reduce it. If there's a decrease in working capital, you will add it. Right? If you see it in the formula part, simply in the formula part, if you simply consider the formula, change in working capital. Okay, so change in working capital, if the working capital is increasing, then increase in value will be positive value, right? So positive value. So automatically our increase was 20. So it will be minus 20. Automatically it will get reduced. And if there is a decrease in working capital, so this part is decreasing, then minus decrease. So this will be addition. Okay. So this is how it works. So I gave you two alternate understandings. So increase and decrease part. So for the simple rule, from the net income, if the working capital is increasing, you will reduce it, you will subtract it. If the working capital is decreasing, you will add it. Remember it. I repeated this at least like 5-6 times in like past 5 minutes. So from that you can understand like how important it is. And I'm repeating it because I know students forget this particular point, makes mistake in this area. Then second formula for the free cash flow for the equity, is cash flow for the operations, CFO part, cash flow from operations minus capex. Capex is easy to understand. Company spent or invested in plant, machinery and so on. So this is cash out, right? And then plus net borrowing. What is this net borrowing? Simple. Minus principal payment on debt plus new debt, which is exactly this part. This part. Okay, this and this. So instead of writing like the minus principal payment plus new debt, we are simply writing as net borrowing. Net borrowing means principal payment and adjustment of new debt. So if the net borrowing is positive, that is cash inflow, so you will add it in cash CFO, cash flow for the operations. If net payment is there, then you will reduce it. Okay. So always remember these terms, even though these terms are net borrowing, the positive term, you should not add it like whatever the value, you should not be adding it. Okay. If the net borrowing is negative, then you have to reduce it. If the net borrowing is positive, then you have to add like this. Even same is applicable for the capex also. If there is, say, instead of purchase of capital assets, there is a sale of capital asset. So in that case, you have to add the cash. Okay. Remember these are the confusion points. Fine. So this is the setup. Then based on this, you can solve the simple question. Okay. The question is simple. Okay, so now, once you have the cash flow from equity, so we can again use the same formula. So here the formula will look like this. So cash flow, okay, CF1, you will discount it. Then say CF2 plus terminal value, the share value, and again you will discount it. Fine, simply like whatever is the cash flow, you have to do the cash flow calculation. Here, if you want illustration for your understanding, let's say like the cash flow from the operations is 1,200 is the capex, net borrowing is the 100. Simply solve this, whatever is the answer, put it in this say CF1, okay, and then for CF2, let's say this is say CF1, and for C cash flow 2 is say 800 minus 100. Here we have sale. Okay, remember like this. Okay, so you have cash flow 1, cash flow 2, and now plug these values and you will get the answer. So what's happening here in first case? So it is cash flow from the operations is positive. We are having the capital expenditure of 200, so cash payment of 200, and then net borrowing. So funds are coming inside. So the 100 is the net borrowing, positive. Now in the next cash flow 2 part, it is 100 cash flow from the operations is positive, minus 100. This means we are receiving cash. Okay, so minus will get positive. So you will add this cash, and then there is a net borrowing. In this net borrowing, there is net payment of debt. So your debt is reducing. So here it will get reduced. Okay, so this is how the setup works. So you have to do this calculation, and let's say the terminal value is 200 and discount value is already given like the 8%. Simply use these values and calculate the answer. Same thing is here. For this, let's say the net income, I'll just again give you the example. Net income is 500, depreciation is 50. So you will add the depreciation. Change in working capital. So in case 1, I will give plus 120, and in case 2, I will give minus 100. Okay, so plus 120 directly, remember this value you have to put in this only, okay, and then whatever is the plus minus, then you have to multiply it and solve it. So if there is an increase, this is plus 120, so this will be the plus 120, but remember this is in the minus. This sign is separate, so you will minus it and automatically it will be the minus. And if the working capital is decreasing, then it will be added back. Why it will be added back? Because this term will be minus 100. So minus will become plus, and then it will get added. And let's say the capex is 0. Then debt payment, principal payment is 20, and new borrowing is 50. Okay, so simply use these values, and again the terminal value is there already given. Okay, so you can solve this. Okay, so this is how, yes, you just need to know how to plug the values and get the answer. That's it, as simple as that. Okay, nothing is difficult here. Solve 1 or 2 questions and you will understand. Now the question, how to calculate this KE? K is known as the required rate of return by the investor, equity holder. Required rate of return by equity holder. Now, how to calculate this required rate of return? So, formula is very simple. This is if we use CAPM, okay, CAPM model, capital asset pricing model. Then the formula is, again, I assume we are done with the portfolio management preparation. So it is RF plus beta into RM minus RF, and this is how you do the calculation. So let's see the example. So RF is risk-free rate is equal to 5%, beta of this stock is equal to 1.2, and RM expected market return is 15%. So 5 plus 1.2 is the beta, 15 minus 5. Simply solve this. 15 minus 5. I'm going fast here because I'm assuming you already understand this concept from portfolio management. We have detailed discussion in portfolio management. So answer is 17. Okay. So K is 17. So this K, cost of equity or required rate of return, this K is also known as the cost of equity. So cost of equity or required rate of return by the equity holder is 17%. So if the K is 17%, then for discounting, we will use 17%. So in exam, the possibility is maybe the K will be provided, or you have to do the calculation of K and then you have to apply it in the dividend discount model. Okay, so all the possibilities are there. You have to just be aware of what you need to do. So this is about the equity, common shares. Now the preferred stock valuation. Now preferred stock valuation is very simple. Okay. So here, assuming that non-retiring preferred stock, okay, so, and the dividend payment is fixed here. So the formula is P0 is equal to, formula is dividend on preferred stocks and required rate of return of preferred. Remember, the KE stands for equity. KE means equity. So cost of equity. So this KP is cost of preference share. So this means this is required rate of return. In simple terms, required rate of return by preference shareholders. Okay. So by preference shareholders. So let's say required rate of return is say 9% and dividend paid by the company is say 10 in dollar terms. So here 10 divided by 9%. Remember, you have to use 9% directly or simply like this. Okay, and then you will get the share price. So 10 divided by 0.09. If you solve this, so answer is 111.11. So the preference, the value of preferred stock is equal to 111.11. This is applicable. This formula is applicable when we assume that this is non-retiring preferred stock. Okay, and we are able to use this formula. This formula is usable in the preferred stock for very basic reason. The reason is in preferred stocks case, the dividend is promised. There is a fixed dividend, right? So there is a promised dividend. So we already know what's going to happen with the dividend. And for this reason, we are able to use dividend directly in this equation. Okay. This is simple perpetuity formula, nothing special here. Fine. So again, just remember the formula and learn how to plug and play. So common mistake areas are not there, like the dividend is the dividend. One more thing. So this dividend is on the face value only. Okay, same thing. So preferred dividend is on the face value. So if the face value is 100 and dividend is say 5%, so you have to calculate 5% on the face value. Okay, fine. So once we are done with this, next discussion is on the Gordon's growth model. Gordon's growth model. Okay. Now in Gordon's growth model, what happens? Just understand this. In previous, like in the same video, we discussed the dividend discount model, right? So dividend is there, right? At the time of T1, T2, T3, so on. And we are discounting it. So what Gordon did, Gordon used the dividend discount part, okay, the same equation with one additional assumption and squeezed it into one single formula. And this formula gives us again the share price V0 only, V0. And here the formula is D1 divided by KE minus G. D1 divided by KE minus G. Now here the assumption goes like, so if I provide you like say just longer formula for this, okay, on just like the surface level. So it starts like this. So D0 is the current dividend or the past dividend paid by the company. And the assumption is there is growth in the dividend. Dividend is not going to, in dollar terms, dividend is not going to be exactly same, right? So it will increase. There will be growth in the dividend. So here, this goes like this. So D0 multiplied by 1 plus G divided by 1 plus R to the power 1 in both the cases because this is for the first period. Plus D0 into 1 plus G to the power 2 divided by 1 plus R to the power 2. Then D0 1 plus G to the power 3 divided by 1 plus R to the power 3 and so on. Now see what's happening here. We are simply calculating dividend at the point of T1, T2, T3 and so on. And then we are discounting it by 1 year, 2 year and 3 year. So here if I start with the assumption of dividend is equal to 10 at D0, D0 is equal to 10. And let's say growth rate is 10%. So dividend will grow at 10%. And say R is equal to 12% or K and R is same here. So obviously it will work like this, right? So here D0 into 10 into 1.10 is equal to 11. 11 is the dividend at the T1. 1 plus 0.12 to the power 1 plus. Now this at time T2 dividend multiplied by 1.10 multiplied by 1.10, it is 12.1 dividend at this point, 1 plus 0.12 to the power 2 plus again at this 3. What you can do, you can simply like multiply it by 1 plus G and you will get the D3. Okay, so 12.1 multiplied by 1.10 is equal to 13.31, or what you can do, 1.10, that is a growth rate. So 1.10 to the power 3 multiply by D0, both will work. It is basic simple mathematics. I'm assuming you understand all these mathematics. Plus 0.12 to the power 3. And this is how this equation is working. So we have dividend which is growing at a constant rate and then we are discounting it. Okay. And then here we will have like dividend for long. So what Gordon did, Gordon, instead of doing calculation step by step, he used mathematics, converted these equations into the close-ended equation, where now we have D1 divided by KE minus G. G is growth rate. D1 is simply D0 multiplied by 1 plus G. That is simply the D1, the dividend at the time T1. Okay. And this K is K, cost of equity. Required rate of return. Now the question is like, once you know this, it is very simple, right? So let's say the dividend is equal to 10%, growth is equal to 8%, and cost of equity is equal to 12%. Now you have to do the calculation, okay? Find price, P0, okay? So P0 is equal to dividend. By mistake, I wrote it as 10%. It should be 10 only, not 10%. 1 plus growth, 0.8 divided by KE minus G. And simply solve this and you will get the answer. So 1.08 multiplied by 10 is equal to 10.8 divided by KE minus G, 0.04. So divided by 0.04. Answer is 270. That's it. Okay. So this is a Gordon's growth model. Now, what are the assumptions here? So in Gordon's growth model, we have certain assumptions. First, the assumption number 1. Here, this G and KE are constant. Okay. So see this, like in the equation, we don't have space for variable G or KE. So that's why the G and KE is constant. Second is dividend is appropriate measure of value of company or share. And third is KE should always be greater than G. This is the most important assumption. Why? Because if you put KE is equal to 10 and G is equal to 12%, then maths will fail here. Okay. So you won't be able to apply the mathematics. Share price will, like, it is simply like you won't be able to work with this calculation. Okay. Share price will go the negative. So this KE should be greater than G is very important assumption from the maths perspective. Okay. Got it. So this is the basic concept of the Gordon's growth model. And if you understand this, like how to apply this, the general mistakes are first, some students end up using D0 instead of D1. Okay. So that's why I gave you the specific, like the formula where this is the D1, or you can simply write it as D0 into 1 plus G. Okay. So remember the formula like this, or if the D1 is provided, use D1. If the D0 is provided, then 1 plus G. Okay. D0 multiplied by 1 plus G should be applicable. So D1, never use D0. And D1 is simply means like dividend at the time T1. If you see this on the timeline, so this is the T1, this is the T0. To calculate the price at T0, you have to take the dividend at D1. Okay, you can't take the dividend of D2, D3, D4, so on. You have to take the dividend on D1 only. If you have dividend at D2 or D3, then we have slightly different method. Okay, so we have to simply tweak the maths. There is nothing like amazing in this, but just some maths, but basic mathematics is different. Now this is the growth rate. G is growth rate. Growth rate is denoted by G, and this G is also known as sustainable growth rate. Now, how to calculate this growth rate? The growth rate is calculated as retention ratio multiplied by return on equity. So here retention ratio, let's write it as RR, retention ratio multiplied by return on equity. So this simply means how much portion is retained by the company and what is the return on equity. How much is retained? Retained simply means this year whatever is earned by the company, out of this earning, out of this net income, how much is retained by the company and how much is distributed by the company. If company earns 100 and pays dividend of 20%, so 20% is paid in the dividend. Okay, so I'm not talking about the dividend rate here. I'm talking about the portion of EPS. 20% EPS is paid in the dividend. 20% is the dividend paid, which is known as a dividend payout ratio, DPR, dividend payout ratio. So company retained as in company is holding 80% of this 100 with them. So 100 multiplied by 80% is equal to 80. 80 is retained by the company and 20 is paid in the cash by the company. Very simple, right? So 20 paid in cash, 80 retained by the company. So 100 multiplied by 20%, 80%, you have to do this calculation and that's it. Now, if the company is retaining 80 and return on equity is equal to say 12%, return on equity is equal to 12%. So this means next year, company will earn 12% on this retained amount. this amount is retained by the company, right? So 80 is now extra. So on this 80, company will earn 12% next year. Next year, company will retain again, and on this again, company will earn the return on equity, and this will keep happening. And that's why we take the G is equal to retention ratio multiplied by return on equity. If the retention ratio is 80% and return on equity is 12%, so your G equal to G is 0.8 multiplied by 0.12 multiplied by 100. It is 9.6%. Okay. So 9.6% is the answer. So this will be the G. Now we will use the G. Now this retention ratio can also be written as 1 minus DPR, dividend payout ratio, multiplied by ROE. So what is the DPR? 1 minus 0.20, 20% is the dividend, multiplied by 0.12, return on equity. Now again do the calculation, it will be 0.80 multiplied by 0.12. If you solve this again, 9.6% is the answer. Okay, so this is the formula you have to remember. If you have not the G is not directly provided to you, then you have to do this calculation. So RR multiplied by return on equity. Fine. Okay. Now, once you understand this, we'll move to next discussion. First, understand some implications here. Implications of like this Gordon's growth model. So as the difference of KE and G increases, stock price if the difference between K and G is more, then stock price will be lower. If it is less, then stock price will be higher. You can see this, like this is based on the mathematics only. Let's assume the dividend of 10 and let's say K is 12 minus 0.12 and growth is 0.10. Okay, versus 10 divided by 0.12 is the K and growth is say 0.04. Okay, so in this case you will see like here the price will be higher, here price will be lower. Those who are good with the mathematics, you will understand, like because here in the decimal form we have small value, automatically it will increase the final output, and here in the decimal form we have bigger value, so it will decrease the output. So simple, 10 divided by 0.02, answer is 500 in this case. This is small, okay, gap is small, and here answer is 125. Okay, so remember, as the difference here, the difference is 0.02, here the difference is 0.08. So as the difference increases, stock price will fall. This is the point you have to remember. Next point, small change in KE or G will cause large change in P0. Very simple. Why? Again, the mathematics, right? So if you increase, or if you simply change it by 1%, if you change the KE by 1%, then the price won't be affected only by 1% like this. So this is what you need to understand. Okay. Now, so we discussed the growth rate already. Now, how to estimate the growth rate is the discussion. How to estimate the growth rate. So first, estimation of growth rate. You can take the historical, okay, historical growth rate. Just check what was the growth rate in the dividend in the previously, using the empirical data based on the history of the company. So you can take this. If the historical growth rate is reliable, go with that. Second is, take the average growth rate, average growth in the industry. So for now, industry's growth rate is say 10%. So we will assume like sooner or later, company will also give the growth rate of 10%. Or third is sustainable growth rate, which is calculation based, right? So retention ratio multiplied by return on equity. This is the formula. Okay. Now, our next discussion. Okay. Now here we will see some tweaks in whatever we learned in the dividend growth. Okay. Dividend discount, not the dividend discount model, the Gordon's growth model combined with the dividend discount model. Now, if there is a variable growth, or no dividend in beginning, then how to do the treatments? Okay, so this is the question. So let's say, for example, 1 2 3, so this is T1, this is T2, this is T3, this is T4. Now you are provided with this information that currently company is not in capacity to pay any dividend. For this reason, company have decided, or management have decided, to pay the dividend at T3, or we can take T4 also. Let's say the company has decided to pay the dividend at T4. So at T4, company will pay dividend of 15. Company will pay dividend of 15 at T4. So what about T1, T2, T3? No dividend, zero dividend. Okay. And here the KE is equal to 12% and the growth rate from like after T4. Okay. So from this particular point, the growth rate will be 5%. Instead of 5, let's say like it is 9%. Okay. So growth rate will be 9%. And you are asked to calculate the T0 price, the price at time T0. Now how to do the calculation in this case? So remember, this D here is D4, right? So you are getting dividend at T4. So that's why it is D4. When we use D1, we get the P0 value. So if you use D4 and this information combined with this information, you should get P3. So with D4, you will get P3. With D3, you will get P2. With D1, you get P0. So similarly, using this information, first we will calculate the price at this level. We will calculate the P3. Okay. So P3 is equal to 15 is the dividend. You don't have to add growth here. Remember, we are calculating P3 and already we are taking the dividend at D4. This is a D4, right? So one period later. So this is how it works. So for P3, take dividend of D4. And for say P4, we'll take the dividend of D5. Then divided by 0.12 minus 0.09. So here we will do the first calculation. First calculation is calculation of P3. The P3 is also known as a terminal value at T3. Okay, terminal value at T3. So 15 divided by 0.03, that is 0.12 minus 0.09. And the answer is 500. Okay, so P3 is equal to 500. Good enough? Okay, so we got P3. Now, once I give you the P3, the terminal value at T3, can you do simple calculation by discounting this P3 till P0? Yes, everyone can do, right? So we are all are good with this calculation. So we will take in the formula terms, we will take P3 and we will discount it. We will discount it by 3 periods. Okay. So this means 500 divided by 1 plus discount rate is same KE to the power 3. So 1.12. I'll show you here. Okay. So 1.12 y to the power x3, then 1 by x multiplied by 500. So 355 is the P0. Okay, very simple. Now, what if instead of this situation, I'll use the same illustration. I'll cover multiple concepts here. Okay, so instead of this situation, let's say The first discussion is like no dividend, right? Now here let's assume the variable growth. So company is going to pay dividend, but initially company will pay low dividend and then the dividend will be increased. So here company will pay say dividend of 5, then 6 and then 7. So at T1, T2, T3, there is a variable dividend. Okay, growth is variable. You can simply check. See, it is increasing by dollar, single dollar, $1, but in percentage terms, growth is different. And from here to here, so from T3 to T4, it is becoming like 7 to 15. There is big jump. Okay. Now in this case, how to do the calculation? Very simple. Again, you have to follow the same step. Calculate P3 terminal value at P3. Okay. T3 using the same formula. Rest of the information is same, right? Now, to calculate the P0, we have to simply discount each value separately and then this one also. So 5 divided by discounted for 1 year. Okay, I'll directly write the factor only 1.12 to the power 1 plus 6 discounted for 2 years 1.12 to the power 2. Then 7 discounted for 3 years 1.12 to the power 3 plus 500 discounted for 3 years. For exam, always remember this. If this is a situation where the dividend is variable, so it is increasing and then suddenly there is a dividend. So for last two values, discount rate should be exactly same. Discount value should be same. So see this, to the power 3 to the power 3. If this is happening, then you are doing the right calculation. So if by mistake you do this, so instead of say 500 divided by 1.12 to the power 3, you write it as 1.12 to the power 4. Because see, what happens, this is a very common confusion. Because you are increasing power with every step. So here power is 1, here power is 2, here power is 3. So by mistake, it is possible that you will end up taking power of 4 here. Don't take it. Don't make this mistake. Take power of 3. So both will have the terminal value and the last dividend before that terminal value. On that terminal value will have same discount rate. And then do the calculation. Okay. So 1.12 1 by x multiplied by 5, whatever is the answer, store it in the 1. 1.12 square 1.12 square 1 by x multiplied by 6, store it in 2. 1.12 y to the power x 3, whatever is the answer, take 1 by x, multiply it by 507. I am directly adding these two values. Whatever is the answer, store it in 3. So recall 1 plus recall 2 plus recall 3. So answer is 370. 370.12. Okay. So this will be the answer, right? So this is how it works. So just remember the calculation. Okay, then there is a multi-stage dividend, which like on conceptual level we discussed it. On theoretical level, we have phased dividend. Now, what happens in some cases, like there is a 2-phase dividend, 3-phase dividend. Calculation wise, we discussed everything. Nothing left in the calculation part. Just on the theoretical part. So there is a possibility that company may pay low dividend. Okay. Then maybe high dividend, and then the dividend will stabilize. So this is a 3-phase dividend. So there is also 2-phase. So company will pay low dividend and then high dividend. Okay. So for some period, low dividend, after that, company will pay high dividend. Once you know company is going to pay constant dividend, after a certain point, you can apply Gordon's growth formula for that situation only. If the company is going to keep changing their dividend forever, the dividend growth rate forever, it will increase, decrease like this, then the Gordon's growth model is not applicable. Okay. So this is the point you have to remember. Now, there is a 3-phase which is given in the book. So it goes like, first it is a high phase. Okay. Company will pay high dividend, then low dividend, then it will stabilize. Okay. So high, low, and then stabilize. Just like on theoretical level, remember this. High payment of dividend, then low payment of dividend, then stable. So you will apply dividend growth, Gordon's growth model for this part, for low and high, you have to do the calculations manually. You don't have any other alternative. You have to discount each value separately. And for stable part, then you can calculate the terminal value. Okay. So this is all about the dividend, discount and growth models. After this, we will discuss in the next part of the video, we will discuss the price multiples approach. Okay. So thank you for watching this video. See you in the next video. Bye bye. Take care.